Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is David Morgan. He is a returning guest. He's from silver-investor.com. He's a very good investor. He is an author. He has a great book on silver that any beginning investor who wants to learn about the precious metal should go out and buy, and I think he's updating that soon. And thank you for joining us again today, David, to get your insights on the markets and precious metals.
Thank you very much.
Now, David, John Manfreda and I were discussing the macroeconomic situation before we started recording here. The dollar seems to be strengthening a lot. China seems to be on the verge of collapse, or at least their property bubble is. There's humongous problems in their banking system. ATMs are freezing up, potential bank runs. Is this sustainable over the long term where the dollar is just going to continue to get stronger and stronger? Would the Fed even allow something like this to continue?
It's doubtful. I mean, first of all, if we address the China situation, if you go back just a few days, really to the 21st of June, the Shibor, which is the LIBOR for China, dropped 500 basis points, and there was a rumor out that the central bank had to inject 50 billion renminbi into the banking system. It's kind of their version of quantitative easing. And it's still very elevated levels, and of course there's all kinds of problems in China. There's no doubt about it. I've done a couple of videos and updates for our members and others on the public domain as well. I mean, there was, I forget the exact number, but it was over 30 million empty apartment buildings that were built in China. So there's all kinds of misallocation of capital in the Chinese sector, and of course no one can get away with that forever, and they're experiencing their problems with an overly debt-burdened country with misallocation of capital. So this is going to not last for much longer, I think, and the market, whether the powers that be like it or not, the market actually has more power than them, although there's many people that don't believe that. The facts are that that's true, and so the market goes through a clearing process. And we may be witnessing that on a global scale, and it may be, the impetus may be this Chinese problem.
I was also wondering another thing as I was thinking about the Chinese crisis, and they do have a lot of U.S. treasuries on their balance sheet, and in order to provide liquidity, which is they think that is their problem, do you think the Fed this might be a trigger for the Fed to increase its bond buying to provide more liquidity to China?
Oh, yes and yes, and I'm trying to be slightly funny here. Yes, that China certainly could off some of their $2 trillion worth of U.S. debt, and they could do it rapidly. Of course, that would, if they did it too rapidly, it would raise havoc with the bond market. But yes, on the buying by the Fed, because basically they're the buyer of last resort, and it's kind of become that. I mean, as you well know, and most listeners know, that the dollar has been usurped somewhat slowly over the last couple of years. I mean, you've got these trade agreements with, Brazil, Russia, that is, their currencies only, circumventing the dollar, Russia, India, China, Australia, China, Russia. So all of these big nation states that have trades going on with other countries are doing trades direct, meaning that they don't need to go through the U.S. dollar in order to do trading together. So that's been going on for some time. So there's less of a need to purchase dollars when that's taking place. And that continues. So there is sort of a slow move to the exit, I would say, where people are exiting the dollar. When I say people in this case, I mean the nation states. So China's well aware. I mean, these finance ministers and all are well aware of how markets operate, and that if they, tried to exit the dollar too rapidly, it would cause them problems themselves, wouldn't help their system at all. So these type of things that can take place usually are negotiated. In other words, the Fed secretary might go over, or chairman, not that the chairman would, but someone in the high ranks of the IMF or the Federal Reserve or both get together with the Chinese top echelon bankers and work out something and maybe do a deal. But no matter what they do, you cannot get around the truth. And the truth is that there's so much allocation capital, so much debt, and so much panic. I mean, really, it's the power of the people. It's those, 1.2 billion Chinese. Not all of them have bank accounts, of course, but there's enough of them that do, that if they get worried, that moves the market substantially. And this is what happens. I mean, you look at Argentina in 2000, what happened with the empty ATMs. And so it goes on and on. So yeah, I am concerned. In fact, I hate hitting the panic button. I don't like using the fear card. But, I've been on this whole global economic system problem for a very long time. If you go back and read my early work in the very early 2000s, like 2002, 2003, and read some of my work, I was considered somewhat of a crackpot back then for writing what I was writing, but it's stuff that's in the New York Times now. I just happen to be a bit ahead of the curve. So that's where we're at. It does concern me. Is this the beginning? I don't know. I don't think even as it unfolds more rapidly in the future, you're going to be able to point to any one given event that, oh, this is it. Although, history tends to do that. It's like, oh, well, it was the Archduke of Ferdinand, and that was the reason that we got into the World War, and that's a starting point. And you can make that argument. But this is one of grave concern. I mean, everyone's been looking to China to kind of be the bastion of last resort to help the system overall. And, of course, it's starting to have its big problems now.
And one other thing is, while they're negotiating something, they'll probably be talking about tapering on the surface.
Well, I think that was a trial balloon. I think the tapering comment was something that Bernanke might really have in mind, but I think he went ahead and said it to see how the markets react, and the markets reacted probably differently than he expected. That's my take. I don't have a direct line to Ben, but I think he expected to see the commodity sector, particularly gold, go down, which it did, but I don't think he expected the stock markets to go down as well, and they have. And so, and then the bonds. I mean, if you look at the bond market, the debt markets are the ones that are the most crucial. There's more debt than anything else. I mean, you take the entire equity market, and it doesn't come close to how much money it represents relative to how much money there is in the bond markets. And so if you look at the yields, interest rates are starting to rise, and that means that bond prices are going down. And, of course, this happened in Japan. Japan had this, what I consider to be an absolute insane policy of this 2-2-2 to double the inflation rate, get up to 2% in 2 years, which sounds good on the surface. And it was absolutely force inflation onto the monetary system. And yet what happened was the government bond, the Japanese government bond, they definitely said, are you kidding me? And interest rates spiked. So there is a correction, you might say, in advanced capital markets, which certainly the Japanese are, and of course the United States is probably the most advanced capital market, and that is the debt markets, because there's a kind of self-correcting feature, and that is when things get scary and interest rates go up, the price of money goes up, the cost of servicing debt goes up. When that happens, the value of the bonds go down. That's deflationary. So that is the reason I don't think you'll ever see a real hyperinflation in the U.S. or really globally, because there is that self-correcting mechanism. Nonetheless, you can get enough inflation, and a currency crisis really isn't dependent on yield. It's dependent on faith. It's dependent on trust. It's dependent on confidence. And if you get enough confidence that's leaving the system, it doesn't take a vote of majority rule. It doesn't take 50%. It doesn't even take 1%. It just takes enough. And enough could be just a few bond traders that start to panic, and all of a sudden that contagion catches on, and all of a sudden you have a lot more selling of the U.S. debt than was expected. And it sort of cascades on itself. It's the old snowball coming down the hill kind of thing. It starts off very small. It starts to gather momentum, and all of a sudden it can't be stopped.
Yeah, David, my take on this whole thing is that when you look from a macroeconomic perspective, from a top-down perspective, you look at Europe, you look at Japan, you look at the United Kingdom, and now at China, and you're starting to see disasters there from bad central planning, as you noted. And yes, the U.S., the Federal Reserve, has done really, really bad central planning. But we also have quality corporations here who are run by arguably the best CEOs in the world. We have the most liquid, quote-unquote liquid markets. We have companies, like I said, that are well-run. We have dividends and all that, and it's attracted a lot of flight capital here in the short term. But I think that's going to give the Fed and other people, maybe over the long term after they try this tapering talk, as soon as they switch to more of a we have to fight deflation again mindset, it's going to give themselves more rope to hang us with.
Well, it's certainly possible. I mean, my premise is very basic, and that is that no fiat currency lasts forever, and that you reach a point where the growth stops, and the growth stops meaning that in order for a debt-based monetary system to function properly, the debt has to continue to grow because what's given out in the printing press is principal only, so more money has to be created in order to service the debt. And so there's a point, and this is something I missed early on in the 70s, and I was kind of quizzed on, well, you guys are wrong. And I thought, yeah, we have been wrong for a while on why, and the answer, of course, is that there is a limit. There is a limit to how much money creation you can do until it doesn't work. And we're way beyond that point, and I can prove it, or at least I can prove it to myself, and hopefully I'll convince some of the listeners, and that is QE1, QE2, and QE3, and QE ad infinitum. Because the idea being in Keynesian economics that you have to create money, government has to create more money in order to stimulate the economy. So you add more money, and it stimulates, and you get growth. But they've been trying through QE1, 2, 3, and on, and it hasn't. It has not stimulated growth. It has not brought us out of a recession, even though there's a few signs here and there that you might make an argument about. They're really almost worthless arguments in the true sense. The real economy hasn't really grown. So that proves that you've reached the limit. The limit is when you add more and more and more to the system, and it does not get you out of the rut. And so we've hit that quite some time ago. And then, of course, the systemic, which means that everything is interconnected, and if one domino goes, it hits 2, and those hit 4, and those hit 16, and those hit 32, and on it goes. And that's what we hit in 2008, and luckily the system was able to stand due to measures, and whether or not it would have held without bank intervention, or I should say the Fed intervention or not, is to be determined. That's an academic study that can't be determined because they did intervene. But nonetheless, nothing has been resolved since that. In fact, problems only gotten worse. And so we're in a situation, as you, Jason, said, and John alluded to as well, that really, from the top-down perspective, have we corrected anything? And the answer is no, we haven't. We've actually made it worse.
Yeah, and the banks are even more too big to fail now. The European banks are relying on the Federal Reserve to help them out, and the ECB is helping them out too, and there's just nothing's really being solved there. I think they're back to even making those crazy derivatives from the real estate market again. I think I read that in the Wall Street Journal, that they're back to making these crazy derivatives products and betting on them with leverage. The banks have just been fixed so they can make more speculative bets and re-lever their balance sheets. So I just don't see that much changing. And the macroeconomic situation, I mean, the dollar might strengthen a little bit more, but I just don't see the Federal Reserve wanting it to strengthen too much because they all want, as you said, there is no real growth. They know this. They're not going to go out and say it publicly in the statistics, but they're going to go out and tout all the nominal GDP factors. They're going to give those industries like real estate and the banks and healthcare stocks and the home builders and all those other guys, they're going to give them free capital. They're going to let them do leverage buyouts, buy back their own stock to move earnings higher as part of the wealth effect. And then they're going to let them continue to try to operate as if the status quo and try to grow their companies and their industries, even though there's no real demand for a lot of their products.
Well said. Yeah, I don't have anything to add.
Well, let's transition here to gold and silver. So I hear tons and tons of bear arguments. I read the bear arguments out because I'm curious about their opinion, what the mainstream thinks about people like us. And I've heard this recently, that there is no demand for gold and silver. So what is your take on this? I mean, because there's statistics coming out in the last couple weeks from the World Gold Council. Do you think those statistics are accurate from India and China, where demand from India is up 27% over the last year and demand from China is up over 20%? Do you think those are accurate, or do you think demand is actually dropping?
Well, it's a tough one. I would say I use the mainstream studies, and I quote them. A lot of analysts or internet types that comment on these markets. In my view, everyone's entitled to their opinion. That's fine. And but what I don't really like is when people just start using numbers and don't quote their sources. So I'm not extremely fond of the World Gold Council, and I'm not super fond of some of the studies that are done, but I think that's definitely a starting point. I think they're fairly accurate, to be honest with you. I think that they have probably as good a data as you can probably get, and I do think that there is definitely a big increase in demand in both China and India. I think it's because these people have long histories of knowing what happens on a government-based monetary system. They know it's basically a fiction and it fails. So that's a history lesson that isn't lost on those two countries, whereas in the U.S. I think it's lost on almost everyone. And so there is a demand there that is for physical. The problem, you might say, and I'll call it a problem with gold and silver markets, is the same problem that's pervasive throughout the entire economic system, and that is there's the real economy and then what's called the fictional economy. And the fictional economy is basically the entire financial world. Now, there's a little bit of exceptions here, and I want to make this succinct, but what you have in the financial sector is you have derivatives, and that's the problem. So you have gold, real gold, and then you have a piece of paper that's a derivative. You have an option on gold, you have a future contract on gold, you have an over-the-counter derivative of gold, or you have a option on a future, on a forward, and it goes on and on and on. So all markets have to match. In other words, for every buyer, there's a seller. But the problem is in gold, silver, and in the markets. This is true in the stock exchange. This is true throughout the financial sector. You have something that's real, and then you have something that's derived from that reality that's a fiction. And so if you buy gold, you might buy gold by buying a stock, which is the GLD. The GLD is not gold. The GLD is a stock investment. It represents gold, but it is not gold. But yet someone that says, well, I want to buy gold, so they press their mouse and they buy some GLD, and they really think, a lot of them, that they've bought gold. Well, they really haven't. They bought a stock. So this is the problem. So you've got a lot more available product than really exists in reality. And so that would tend to go back to economics 101, it's supply and demand. Well, if the supply is X, but if you add in the derivatives, it's 10X, then you just increase the supply tenfold by doing what? By putting on a piece of paper or derivative or electronic product, however you want to think of it, that isn't really real. It's based in reality. It's based upon something, but it's derived from that. And the bottom line, if you go to touch it, it doesn't exist. It's just some kind of an entry in somebody's bookkeeping or their computer or whatever. So that's the problem throughout the system, and particularly in the precious metals markets, because most people really don't want to bother, and we're talking the large money particularly, not so much the little guy. The little guy is more inclined to buy a gold coin or gold coins or a gold bar or gold bars or silver coins, silver bars, that type of thing, than the big investors. The big investors, pension funds, hedge funds, that kind of thing, or moving millions or tens of millions or hundreds of millions, tend to go into these financial derivatives because it's easy. You can get into the GLD with the mouse click and buy, millions. Whereas if you call up, a few of the larger coin dealers that I know on a personal basis, and these guys move a lot of product, but you call them up and you say, I want to buy $100 million worth of silver over the next, 2 years. Let's just start, it's going to, that would move the market, because you're not going to be able to get that kind of physical product in a short amount of time. But in the fictional world or the derivative world, you can. So I probably droned on too long on that, but I think it's important for people to understand, how can these prices be where they are? Well, because there is the real stuff, and then there's everything else. And there's a lot more of everything else than there is the real stuff.
And that's a very good point, David, and that's just something else that John and I also hear all the time from the bears, is I hear repeatedly that there's plenty of above-ground gold for everyone's orders to be filled. I think the statistic is there's over 150,000 tons of gold above ground, but then how come Germany's not getting all of its gold back immediately? How come allocated accounts are being stolen from and cash settled? How come the Wall Street banks are rating whatever metal there is from the GLD? They've been increasingly rating it in amounts since January, and it's only accelerated. If there was plenty of gold above ground, David, for everyone's orders to be filled, how come they're doing all this stuff if there's so much supply of above ground for everyone? How come they're doing this and then selling it into Asia at a premium?
Exactly. No, point's well made. I can't add to it. It's a precise look. I mean, let's go back to the one. I think the most important one. That's a nation state. I mean, when Hugo Chavez wanted to go back for Venezuela, this big, this tin horn dictator, this, and the press paints him in a certain way, the liberal
Crazy
press. But regardless, I mean, it's their gold, and they did get it back. And he had the armored trucks going through the city so that the citizenry could see it and all that. And, of course, it's kind of a nut job. But then Germany is not considered a nut job by the West. And they wanted their gold back. And yet the Federal Reserve in New York says, well, guess what? 7 years. 7 years? Are you kidding? So exactly what you said. I'm sorry to repeat, but I think it bears repeating. If there's so doggone much gold out there, then, well, what's the big deal? Why isn't it there in 7 minutes, not 7 years?
Yeah, it sounds like what I'm seeing is that Wall Street's definitely just living in an alternate reality. If there was so much above ground gold, there's Germany, and many. If you just buy it from a retail dealer, you're going to have waiting times from 6 weeks. Premiums and waiting times have come down a little bit, but just go try buying silver and selling it, 2 weeks from now. You won't even have it in your hands.
Exactly. And, both the markets are fairly tough to analyze, although not overly so. On the silver side, it's a little tougher, I think, from the aspect that there's such a small market and there's so small a demand for physical that you always, and this applies to gold somewhat, have to look at, what is the demand? I mean, if you're looking at Silver Eagles only and you extrapolate, something that's used to sell 10 million ounces a year in a market that produces about 1 billion ounces when you consider recycling and mining, you're looking at a very small percentage and saying, you're projecting from that small amount what the market's doing. You can't do that. I mean, you can say that there's a tight market in Silver Eagles because that would be a fact. But to say that there's a tight silver market because the Silver Eagle supply is tight is ridiculous. You can't do that. I hear that all the time on the Internet. There's a lot of, in fact, guys that I think are extremely smart will make statements that at least imply that strongly, that, oh, my gosh, look at these mints. They can't get silver, therefore there's a shortage of silver. No, that's not true. What it means is that the mint can't keep up with the demand for that certain product and that product only. So when you look at that, is that a fact? Yes. But then you have to go to the big picture and say, what's the industrial side of it look like? In other words, what's the commercial bar look like? How much is there in the LBMA? How much is there in other warehouses? What are the refiners doing? Are the refiners not keeping up with demand, or the refiners stockpiling on their shelves? And so you really, it's a little bit bothersome to me because I want to stay objective. Certainly I'm bullish. Yes, I'm biased. I want real money in the system. I want honesty in the financial system. I want the system to go back to something where it's equal level playing field for everyone. It's not just for the people that are able to create money at will and give it to their friends first. I think that's very unethical and so moral. Nonetheless, coming back on point, so you need to look at the big picture to say that there's a shortage here or there. The market is still fairly tight in silver, but we haven't seen any of the bigger players come up and step up to the plate where you have like a Central Fund of Canada or perhaps the PSLV or the Zurich Continental Bank or one of these bigger silver investors come in and say, geez, silver's around under the $20 level right now, and we want to take another tranche of silver at these prices. But not ruling that out, of course, could happen, but we haven't seen it yet.
And one thing I wanted to follow up, you spoke about the mints. A lot of the mints actually had to, because of last year, a lot of people were unsure about monetary policy. They were unsure about the elections. The mints had a bad year, especially the U.S. mint, and they had to lay off workers. And because of the low price, demand for coins and bars have skyrocketed. And do you think this sort of quote-unquote shortage is also a logistics issue? Just there's not enough workers? Because Perth Mint, they actually increase production, and their premiums haven't really risen like the other products.
Yeah, it's a flow rate problem. I mean, it's something that anyone can understand. If you have a faucet and you turn it on full, and that's your flow rate. That's the maximum flow rate that you can get out of it. Well, you can think of the mint production rate as the flow rate. How many coins can you mint per shift, even if you do double shifts? And there's a number for that. And if the demand is greater than that number, then is there a shortage? Yeah, you could say, yeah, there's a shortage. There's a greater demand than there is supply, but it's for that only again. So that's the problem. It's the flow rate, it's the production rate. Now, as you said, because of what's going on in the economy, the mint isn't like the highest thing on the government's list of things to do. That's the only one, to my knowledge, that makes a profit. Everything else loses money and it's in a deficit situation. So, why would you put any emphasis on something that actually makes money for the Treasury? But anyway, I'm trying to be a little humorous here. But so, yeah, you're right. I mean,
But David, all the bailouts made money on Fannie and Freddie and all the bank stocks and AIG. They made a profit, though, or that's at least what they're telling people to justify any future bailouts.
And GM paid us back.
Yeah, the government made a profit on every single bailout.
Goldman Sachs paid us back, too.
No comment.
Okay, all jokes aside, sorry, we'll let you get back to making your point.
Well, I'm done. I'm done. I'm agreeing with John that, yeah, it's a production rate problem. And so will that be rectified in the future or not? I don't know. One thing I do want to – add one more thing, and this is this January shutdown. This drives me nuts too, so I'll vent a little bit. Every year, it seems, more and more people get involved around the silver story, and that's great. I'm all for it. But you always get, oh, my God, January, look at they shut down. Well, they shut down and stopped minting in November every year since they started. And why? Well, there's a very simple explanation for this, but no one ever talks about it. It's because the year changes. So when the year changes, guess what? The dies that say 2012 are not any good anymore. They have to make new dies that say 2013. And guess what? They close down. And then they take the dies out that say 2012, and they do maintenance and cleanup and that type of thing and get ready to start minting again with a new year. But every year I read all this stuff about, oh, my goodness, oh, my gosh, and you see this wringing of hands is jumping up and down and these, all kinds of hoopla around the mints, taking some time off or going into, no production or whatever because of no explanation. Well, the explanation is very simple. The year changes. They have to shut down. They do some maintenance. They got to put a new die into place and start production again. So those kind of things kind of get to me because I don't mind, again, everyone having their opinion. I mean, that's the beauty of the Internet. But some of this stuff is just pure absolute nonsense that gets out there, and yet no one really calls any of these people to the carpet. And you notice I'm not using any names because I don't think that's fair. But I also want to point out the fact that this is just, this is natural, normal business, and that's why it takes place.
And it's probably not as quick a turnaround, David, as it normally should be because the government, due to government unions, which are government employees are not supposed to have unions, they'd be paying humongous amounts of overtime to the employees for working through the holidays to change it over. Whereas in the private sector, we don't get bonuses like that.
Exactly. Well said. It's government. It's the bureaucracy. They're not. They're not going to run as fast as they can. I mean, they're going to do it in their own sweet time. And they're going to make the changeover. So, I mean, it's just part of the way the operation works. It's nothing magical, mystical. Oh, my God, look at it. They're out of silver. Oh, no. It's called change the die.
Now, changing the topics a little bit in the gold and silver industry, switching to the miners, you talked about potential supply problems that could come down the line. Now, we have, according to my research and from the last issue of the Morgan Report, you now have silver at or below the all-in production costs for sustaining capital and maintenance capital. You have a lot of primary silver producers producing now below the spot price. So how much longer can this continue? Have you heard of any large primary silver producers starting to hedge or anything like that? What's your opinion on if there's going to be bankruptcies and how long this can continue?
Well, great question. One, who knows how long it can continue. I'm on record. I'll say it again. I don't think it can continue. I don't think it will continue past September, but could it? Yes, it could. As far as the hedging goes, you'd have to check the websites of different mining entities, ones that you're particularly interested in. Some of the more with-it mining companies only hedge their base metals and not their silver. So that's something I think that's just the power of the people again. I think a lot of silver investors are pretty astute and pretty aware. And so they put pressure on mining companies of all levels. I'm not talking about the base metal miners. I'm talking about your primary silver producers that are reluctant to hedge their silver or hedge just enough to like do a debt financing or something like that. I'm very close to the industry, as you well know, and that's the case many times over. The problem with the going out of business thing is there some, and I didn't know this for a long time, so this is something that I learned. It's been years now, but I went on years and years without knowing this, that it's actually cheaper in the long term to keep a mine operating at a loss than it is to shut it down. And the reason being is that, for one, several times there is a penalty that has to be paid by the mining company to whatever location or jurisdiction that it is in. So I'm not saying Chile has this in place, but we'll just use that as an example, that if you're mining in South America, we'll just use it generically. You're mining in South America in a certain country, and you say you're going to shut the mine. The contract with the mine, with the company and the jurisdiction is, well, that's fine. You shut down, but you owe us 3 years worth of costs. So that's an example. That's not an exact, but that's the idea. So that is like, well, the second thing is, if you do shut down and put it on care and maintenance, although care and maintenance sounds like, you just turn the switch back on and everybody's back in business in a month or two. It's not the case. Most minings are extremely labor intensive. Anyone that's ever visited one, open pit or underground, knows. And so once you shut it down, it's very expensive to put it back online. So again, I learned this, some years ago now, but I wonder, well, why don't, you're underwater. Why not? Most businesses would just put up sell it at a discount or go out of business and, move on. In the mining industry, that doesn't seem to be the case, and that's the reason. So they'll sustain, they'll pare back, they'll do minimum, but they'll keep it running because it's cheaper and smarter unless it goes on indefinitely. And, of course, there comes a point where, maybe keeping it going a year is a smart thing to do, but 2 isn't, that type of thing. But I think that we're, again, very close to the bottom. I mean, there's reasons to know that the costs, as you said, Jason and John, that the primary silver producers are running around $20 an ounce, or a little higher actually, and we're at that level. And that doesn't guarantee that the price is going to come back up, but it does guarantee that these miners can't stay at that level for indefinitely because they're losing money, and no corporation, no entity can go on without a profit for very long. So I am probably more bullish on the miners than I've been in a long time, but yet it's been really rough the last 2 years and extremely disheartening since like January. I mean, I just did a video update for all of our mastermind people this morning, and looking at some of these companies that, we know are really, really good, that had, done well through like January 2013, and here we are, 6 months later, and they've just been decimated over the last couple of months or so. And fundamentally, of course, nothing's changed. In fact, some of them have gotten better because some of them are not really exploration companies. Most all of them are producers or near producers, but they're closer to producing or starting to produce or increasing production or that type of thing. In other words, stories that almost every one of them are better, not worse, yet the stock price is down. So it's frustrating. It's frustrating for me, but if you ever read anything about basic investing, you're supposed to buy when blood is in the streets, and I don't like that expression, but it serves the point. And that's where we're at in the mining industry. No one wants to touch them. Your Wall Street buddy says, if gold goes to 1,000, everybody's out of business. That's the time you want to buy. Yet, unfortunately, it's a time when you don't see much buying, and that's just the way it is. Human nature is very, very interesting to study. When people should be buying, they're not. When people should be selling, they buy. So that's just the way it is.
Well, speaking of buying, selling when buying, or not buying when you should be, I think in the mining sector, you don't see a lot of M&A, especially at these prices. I always talk to Jason, I look at some of these companies, I'm like, how can someone not try to buy Colossus for like $4 a share or something? And do you think the reason we're not seeing M&A is, I think it's due to a lot of poor management, and this could lead to the mid-tier ending up doing buying up a lot of juniors for the cheap?
I think that's a good point. I agree. I think that the larger companies for mining have probably gotten too big. I forget the name of the book, but there's this kind of an efficiency study, and there's a certain size group that gets to maximum efficiency, and if you get above that number, you get more inefficiencies. So I think that's true in the mining industry as well. You get, you can get too big. I mean, the Newmont type of situations really need massive discoveries to make the resource base anything substantially grow or even maintain, whereas a mid-tier doesn't need as much. And of course, they, in my view, should be a little careful. You want to keep kind of in the sweet spot. But John, I think you nailed it. I think that's probably where you're going to see. I think that's what we focused on starting around 2010. I mean, after the 2008 crisis, and we came back up, and then of course we got overheated into 2011. I didn't like it, but again, I don't control the market on way up or down. But in 2010, we started focusing more on the mid-tier because we felt that was the best risk-to-reward profile that we could find in the sector. And of course, we had pretty good success for a while until we got way up there into the April 2011 time frame, where we got up to the $48 level on silver, and then that peaked. It started down, and then gold actually did its peak after that, which was September 2011. So everyone that says that silver always follows gold doesn't really study the market carefully. I'm not saying that silver doesn't follow gold. I'm saying it doesn't every time. Silver led in that case. It made its peak of 48 relative to where it had been previously in this bull market, and in this bull market, gold didn't peak until September, several months later. Nonetheless, both the bull markets are intact in my view. I just put out a video to our members that was done by James Flanagan. I've known of him for a very long time. I think I met him once when I was in L.A., and it was a very good review. He did 4 videos. I just sent the one that had to do with the metals, and he talked about silver quite a bit. And he's a big proponent of GAN. And I've studied GAN, not to the level that he has, but he makes some very, very good points about the silver market and where we are. And he's of the view that's similar to mine, that we're probably about there now. And don't be afraid. This is a time when you can really make money. And we both are of the opinion that this bull market is intact. This is the bear wave within a bull market. And the last phase of a bull market is where huge money has been made. And I'll repeat something I haven't said in a while, but the easy money's been made. I mean, if you started to get the Silver Investor, when it was called that, and I changed the name of the Morgan Report many years ago, but if you started with us and bought, Silver Standard at, 65 cents Canadian, and the Canada was much less than $1 at the time, the U.S. dollar, and held it even till now. And I think silver standard's down like $7. I think it got as high as 40. You'd have to check the chart, but I mean, you still a lot of these companies. If you got in when we started, you actually still had a very nice profit. Not trying to make excuses here, but the point being is that no one's interested in the market in those days. Most of the new market participants and a lot of buying has taken place in the last couple of years, and almost anyone that's gotten in this market in any form, be it physical, be it derivatives, be it mining shares, be it ETFs, are down on their investments for the last couple of years. And that's typical of a bull market. It's going to shake out a lot of people. So a lot of people are very disheartened. A lot of people, when the market starts back up, will sell out because they've broken even. They want to get back into real estate. They want to get back in the stock market. They want to get back into who knows what. But they don't want to invest in the metals again. And, of course, that's, in my view, a very large mistake because the big money will come rapidly, in my view. This is what happens in any market, particularly the metals markets, because it represents something that's outside of the purview of the normal financial system when you're in the physical realm. It's the only thing outside of a counterparty risk situation. And when that's the main problem, which we're seeing in China, as you said earlier in the show, the main problem is a counterparty risk, and that's pervasive throughout the entire system. They're all interconnected. All these banks are interconnected. The insurance companies are connected to the banks. The pension funds are connected to the insurance companies, and on and on and on it goes. So everyone's interconnected. So when you see the failures starting, I don't care if it's in China, I don't care if it's in Australia, I don't care if it's in India, I don't care where it is. They're all connected. And so this is where you want something that when everything falls down, something's left standing. And I'm using that as a metaphor, of course, but that means that you want something such as physical gold and physical silver. Those are really the only monetary assets that are outside of that whole entire financial structure. And a lot of people won't get that message until it's too late. And when everything does go down, whatever that means, however it works out, and gold and silver are left standing, there'll be 99.2% of the population globally says, well, why didn't anyone tell us? I didn't know that. And, of course, we are telling them, but it's not something you're going to get from the mainstream financial press. It's not something you're going to get from a certified financial planner. It's something that you're only going to get on the alternative media.
Exactly, David. And to add to your point there, after the stock market crashed in 2008, no one wanted to buy stocks ever again. And, of course, that was the exact time to be buying stocks like crazy. And that's what I did for myself and my parents. We were buying, like, Apple at 90, and we were buying commodity stocks like crazy, gold and silver stocks. That's when I first entered the stock market and buying commodities and stuff because I knew the Fed was going to reflate. So it just goes to show you that over the long term, now in the short term, obviously there's pain involved, but over the long term, the contrarian value investing strategy, especially like looking at sentiment indicators and stuff like that, it does work.
Yes, it does. And, I don't know what else to add to that. Jason, you're right. But it's tough because people are hurt. They have the herd instinct, and their neighbor just flipped a house and, made some quick money. And now the guy that's been in the silver market decides that, geez, why didn't I do that? I should have got out of silver. I should get into real estate, and by the time he breaks even on the silver investment and gets into real estate, he'll lose money on both. But, that's human nature.
Okay, well, David, let's wrap up here your view of the gold and the silver market. So on the supply side, you really don't see that many changes except that if the paper price goes a little bit lower, we're going to start to see miners cut back maybe on lower grade ore. They're going to only mine the higher grade ore, but the miners are going to try to run their mines as long as possible then, even at a loss. So they're going to burn through the cash on the balance sheet first, right? Because they can't go to the debt or equity markets. And then what would happen next then? Would we then start to see mergers then of equals where companies then, any company that has cash on the balance sheet is just a 50-50 split and the companies start combining to save themselves?
Right. And there's different strategies, but I think that's a general one. I mean, you go back and visit, mining high grade. If you're in an underground mine, you have different blocks and the geologist knows it. You could, as a strategy, decide to cut out any overtime shifts, of course, get down to kind of maybe half the production rate that you had a year ago, still stay in business, still pay the bills, show a loss, but continue to mine high grade and keep things going for a while. So the flow rate would be less, even though it's higher grade, because you've cut back so much of what your production rate is. So, I mean, there's lots of strategies. But that's the general idea, Jason. I think you nailed it. And if things continue to get worse and worse, then, yes, you're going to see, the finance guys come out. And they're going to say, look, here's a situation. We've got cash. They don't. They've got an asset that's as good as ours or better, or will make ours better, or they're in the proximity, or we use the same mill or the same smelter, whatever, and they'll come together. So, yeah, there's a lot in the future. The main thing is even when you're in the right sector, which certainly this one doesn't look like it has been the last couple of years. In fact, that's where it hasn't been if you're looking short term. But longer term, I think we're definitely in the right sector. And on top of that, even though you are in a sector that's making you money, you need to spread out. You cannot get one story stock or one exploration company or even one stalwart and put all your money in that and say, that's it, I'm investing in the gold and silver sector. You need to spread out. You don't have to buy 100 different companies. I'm not sure you can find 100 companies these days on the junior side, but coming back, you need to spread out, and you have to do it selectively, and there's lots of ways to do that.
Oh.
And one of the ways to do that is our listeners can subscribe to, I think, one of the best values out there for all the production companies in the gold and silver space, and that is the Morgan Report, which we are paid subscribers. I don't get any advertising fees from David, but I've looked at other paid newsletters, and most of them, unfortunately, recommend juniors who don't have any money on the balance sheet right now. And David has been smart enough at least to keep companies that will survive this, and they will thrive in a couple years. They're not the majority of companies that David is in this portfolio, I don't think will go bankrupt. They will survive. Everyone's taking pain right now, but I think like the newsletter writers out there with all juniors, all exploration companies, those guys are just too much risk on for me right now. I'd rather have companies there that have cash flow and have some profits, have cash on the balance sheet, and can go out and buy assets for pennies on the dollar. Go and buy those juniors that used to have 100 million market caps. Go and buy them for 10 million.
Yeah, and also this sounds like a red beans and rice diet. I've listened to David McIlvaney talk about it. Save some money, try to add some to your positions because this market will turn around. It's not a question of if, it's a question of when.
Well, very good. Well, thank you for having me on your show. I appreciate it very much.
Thank you, David. And please tell our listeners about your website and any other products or services you offer.
Okay, well, I'll tell everyone the free stuff, and the first one I think is the easiest, and that's to get on the YouTube feed, the YouTube channel. That's Silver Gurus. Just get on YouTube and type in Silver Guru. You'll find our channel. It's SALVERGURU. The other one would be at Twitter, and that's at SilverGuru22. You can get on our website, silver-investor.com, and at the very bottom, just click one little mouse click. We want a name and an email, and we'll get you on our free e-letter. And it comes out weekly. I get a few free e-letters myself, and I just don't like the daily ones. I just don't have time to look at all those. But we surmise everything in a once-a-week format, which I think is often enough. And then, of course, there's the paid services, which are over on the right-hand side of the website. That you obviously can go. If you kind of want an overall view of what we do, I have a landing page called silverspeculator.com. You can go on to silverspeculator.com and just kind of read. It'll take probably 5 minutes at the most. It kind of goes over everything that we do in kind of a overview format. So thank you for that, Jason.